Well, how are we guys doing? How are you guys doing? Doing good? I asked last this. I'm gonna ask you guys, does it feel like a Wednesday to you all? Doesn't feel like a Wednesday to me. It feels like a Monday to me. It's weird, but we'll be on Friday and that'll feel like a Wednesday, but it'll be a Friday. So I don't know. I'll take them where I can get them. Take it, avoiding Wednesdays where I can get them. So just as a reminder, we've got some big events coming up over the next couple of days. So tomorrow, Ruben Brown will be visiting. They'll be tabling outside. I say this about all the accounting firms, and it's always true, but we got some great graduates that have gone to firms, but Ruben Brown especially. I've got some students that I feel think very fondly of in the past that have gone to Ruben Brown. It's not to say you have to go to Ruben Brown. Don't change your offers right now and say, "Oh, I'm going to Ruben Brown." So Dr. Brown. No, they're all great, but Ruben Brown is an opportunity. If you do not have a job placement, I encourage you to go check them out. There's also a roundtable going on tomorrow night. I think Beta Alpha Psi is kind of coordinating that, but it's from five to six, I believe, which some of the former students and some representatives of accounting firms will be attending. And then Friday, I think we've already talked about it, meet the firms. I expect you all to be there if you can possibly. Are football guys, are you traveling on Friday? Okay. Have you told the coach how important this is?
Not yet.
Not yet. Okay. So our accounting professor is saying that we need to be meet the firms. I wonder how that would go over. No, probably not real well. What time are you all leaving? Because it starts at 10 and you're gonna be leaving at 10. Boy, that's just really unfortunate. That's just really unfortunate. Oh, gosh, I tell you, being an accounting major and a student athlete, that's a mixed bag. So you all won't be able to be there, but you get another opportunity at the Career Expo. So if you can't make it on Friday at the Career Expos, in about 3 weeks from tomorrow, I believe. So there's some other opportunities available as well. Something to keep in mind. All right. Today we're going to wrap up chapter 4. Chapter 4 is this week. Chapter 5 is next week. Guess what's after that? Exam number 1. That's right. Because 3 midterm exams instead of 2. So time flies when you're having fun, I guess. So remember we were talking about risk assessment. And when we talk about risk from an accounting perspective, particularly from an auditing perspective, we tend to think about that in terms of misstatements to the financial statements, but we haven't really defined the idea of what a misstatement represents. And I want to characterize those in one of two ways. They should both be somewhat familiar to you already, but it's to kind of think about this from an audit perspective and loop this back into things that you've already talked about with accounting classes already. So for types of misstatements, we're going to have 2 general types that we're going to do. And it's really hard because the book tends to say, here's 2 types of misstatements, and then later on to here's 3 types of misstatements, and they're contradictory. They're not the same types of misstatements, but they use that term type all the time. So I'm going to try to separate these out. So the first one is basically misstatements that occur just by the fact that we're all human. Okay, these are errors. These are mistakes. We cannot avoid mistakes however much we'd like to. All right. Depending on how much you read into biblical prophecy, there's only been one person on the planet who's ever avoided mistakes. Okay, so the rest of us are kind of doomed, which means that as far as you go, that you're going to make a mistake, and that could lead to a misstatement and financial. And that's the way it goes. So that's the first type of error we want to be able to address. So if I say that one category is unintentional misstatements, then obviously the second category, the second type, is going to be intentional misstatements. What do you think another word for an intentional misstatement is? Fraud. Yes, intentional misstatements are fraud. From an audit perspective, we're concerned primarily about 2 areas of fraud, and those are the 2 we're going to focus on. That's going to be misappropriation of assets or theft, and fraudulent financial reporting. Now, if you're asking, is this only types of fraud? The answer is no. There's actually a diverse array of fraud. This only captures a small part of it. There's definitely another area of corruption and bribery that we can go into. The reason that we don't cover corruption and bribery from an audit perspective is it's really hard to categorize those as misstatements, and they don't really have a financial statement effect. So we're going to keep it to these 2. Now, let's just talk a little bit about these 2 categories of fraud, these 2 areas of fraud. From a frequency of occurrence perspective, so organizations that report fraud, frequency of occurrence, which do you think they report more frequently? Misappropriation of assets or financial statement fraud? Take a guess. Misappropriation of assets by almost a 10-to-1 margin, okay? 90% of all recorded frauds are misappropriation of assets, only 10% are fraudulent financial reporting. All right, let's change this question. From a magnitude of fraud, so the size of the frauds themselves, which do you think are larger, misappropriation of assets or fraudulent financial reporting? Fraudulent financial reporting by a 10-to-1 ratio on that one, 10-to-1 margin. So on average, the misappropriation assets about 150,000. Reported financial statement frauds are usually on about $2 million on average. So fraudulent financial reporting occurs less frequently, but is usually much larger in magnitude. And the reverse is true when we talk about misappropriation of assets. So definitely going to be things that we're concerned about from a reporting perspective and from an audit perspective. Now we're going to drill down a little bit into these and figure out what it is that we have a responsibility to do as a as auditors with respect to responsibility for fraud. But let's go ahead and talk a little bit more about some other types of misstatements. So I'm going to call these generally categories of misstatement. And this is a way to think about misstatement from an audit perspective and how misstatements can occur on the financial statements. Now, the first category, by the way, these move from more objective to less objective the further we go down. First category I want to talk about are going to be factual misstatements. These are misstatements about which there is no doubt. The auditor can walk into the audit committee and say, I know for 100% fact that this is misstated by $100,000 or whatever the dollar amount may be. Generally speaking, this occurs when there is a violation of GAAP. The reason why is because if it's a violation of GAAP, we can backtrack and we can say if they used a GAAP approved method, this would be the result. So say, for example, they're using an inventory method that is not approved by GAAP, like a market value of inventory method. So the inventory valuation is, we'll say $10 million. And we as auditors say, if we applied the first in, first out method, then it would only be $9 million. The difference between those is $1 million. We know for a fact that financial statements are misstated by $1 million. Now that is predicated on using FIFO. They could make an argument, well, what if we used a different method? And then that's true, we could use a different method that's GAAP approved. But if we used a GAAP approved method, in this particular case, FIFO, we know that the financial statements are misstated by that amount. We have no doubt whatsoever that that's the misstatement. Those are good misstatements. Those are misstatements about which we auditors can go in and say, we know more than you do, and stick our tongue out. That rarely gets to happen, that rarely gets to happen. More frequently are going to be the other two categories of misstatements. That's going to be our judgmental misstatements. So judgmental misstatements are misstatements that arise from the judgments of management that the auditor considers inappropriate. So remember back in 303, did most of you take it with Dr. Deers, or did anybody take it with Dr. Shoniwa? Okay. We don't like to bring up the cursed one's name in here, but anyway, he's got to see this video. So why are you talking trash about me, man? So yeah, because I always talk trash about him. I talk trash about him when he's here, so it's okay. So yeah, Dr. Deers, when she was teaching about that, she would say when we do allowance for doubtful accounts, we use bad debt expense as kind of our metric for that. So it was like, say, 2% of bad debt expense. Let's say we as auditors consider 2% of 2% of sales, I shouldn't say a bad debt, 2% of sales is bad debt expense. Let's say we think that is an appropriate amount. The client says we're going to use 1%. Who's right in that situation? Auditors, Dr. Barnes. The auditors are always talking. All right. No, it's a matter of judgment. Neither one is right. It's just one thinks they're more appropriate. Now, it's more frequent that the client is going to go for a more aggressive measure than the auditor. So if they only use 1%, then they're understating bad debt expense by a certain amount. We think that's a misstatement, but that's not to say that the misstatement is factual like it was in the other situation. It's more of a misstatement based on judgment of the auditor versus judgment of management. So that's a little bit more dicey. Then we have projected misstatements. These are auditors' best estimates involving the projection of misstatements. So let's say that we get the asset, the property, plant, and equipment ledger together, all the depreciable assets together. We calculate depreciation for the client, and we think depreciation expense for the period should be $10 million. The client has only recorded $8 million of depreciation expense. Obviously, we're going to investigate that, but we have projected $10 million. They've only projected $8 million. Who's right? We don't know. Based on our projection, it should be $10 million. Is there a reason why it might be less than $10 million? Yes. There's a possibility. So this is just a projection on the base auditor, and it's a very loose conclusion in most situations because we don't have all the facts. So comparing our projection versus what the client's actual amount were could lead to misstatements. These are the ones that are most challenging to actually uphold, but sometimes we have to actually we actually have to use. So again, factual misstatements, we have no doubt. We know 100% that this is misstated. Judgmental, management's judgment versus auditor's judgment. Projected, auditor's projection does not match what the client's reported amounts are. Those are the three categories of misstatements. All right. So when we are trying to consider fraud with prospective audit, so first of all, we've talked about this already. We talked about in the planning phase that auditors have a responsibility to detect illegal acts that have a direct and material effect on the financial statements. But what does that mean? What does the auditor's responsibility mean? Well, when they're planning the audit, the auditor is going to perform a few specific tasks. First of all, we're going to have a discussion amongst the audit team. And by the way, when you see bold, that means that I'm going to have more detail on that in later slides. So discussion among the audit team regarding the risks of material misstatement due to fraud. Secondly, we're going to inquire of management, the audit committee, and others about their views of the risk of fraud and how it's addressed. We also want to consider any unusual or unexpected relationships that could have been identified in performing analytical procedures and planning the audit. So remember, we talked a little bit about risk assessment. We said preliminary analytical procedures are a required step. The whole goal of this is to identify, is there anything unusual or something we did not expect that came up that we might want to investigate further that could lead to an identification of a misstatement. We also want to understand the period and closing process, investigate unexpected period and adjustments. So you'll notice it talks specifically about period and adjustments. Why is that the case? The reason is that when you're talking about fraud, a lot of times that is driven by factors that occur close to period end. An example of this would be a manager who has got a very large bonus on the line if they meet a certain sales goal. And they're going to come up just short of that sales goal. What would you do if you wanted to get your bonus and you we're going to be short of your sales goal? What would you do? Nothing. I'm an honest person, Dr. Barnes. Yeah, just immediately run towards fraud. Now, if you were going to commit fraud and you wanted to do the sales goal, so you were going to overstate your sales. You're going to create some fictitious sales. When would you do that? Probably close to the end of the period, because that's when you know that you're going to come up short of your sales goal. So we as auditors are going to say, that's really weird. They averaged about $20,000 in sales a day, but on this final 2 days of the year, they had $50,000 in sales. Is that just something that happens frequently? And that's when we would investigate, say, all right, there's some unusual entries that we want to take a look at. Then we also want to perform an identification assessment of fraud risk factors, which those of you who remember from AIS, this is going to look really familiar. Some of these slides are going to be verbatim some of the slides we talked about in AIS when we talked about fraud in there. All right, so first of all, let's talk about the discussion among the audit team. Now, these are called informally, the vernacular that they use is called brainstorming sessions. And the idea is that we want to share amongst the people who are on the audit engagement team some notions about what is going to be the susceptibility of fraud, the exposure of the client to fraud, and what are some ways we as auditors can address that. What are some ways we can do that? So we want to encourage the engagement team members to share and communicate information obtained through the audit that may affect the assessment of risk and material misstatement and the auditor's response to the risk. So during the brainstorming session, we're going to look at the client's financial position. We can share knowledge from previous engagements. We can share knowledge about the client, anything that we have, and say, these are some risks that we've identified with respect to fraud that we need to address. This can also be a point where we say, this is where we need to evaluate over the course of the audit and reassess these conclusions if we find something that's a little bit weird over the course of the audit. So this is just basically a plan for how we're going to address fraud over the course of the audit. One of the interesting things, this was first created back in the early 2000s for obvious reasons, but this idea was first created about brainstorming sessions in the early 2000s, and they encouraged engagement teams to be creative in their approaches. Because one of the things they noted is that audit had a very, very low frequency of being able to detect fraud that occurred with their clients. It was a real problem, which actually leads to an interesting question about the next thing I want to talk about. So, of reported frauds that have occurred over the last 25 years, what percentage of them do you think were detected by the external auditor? What percentage? Okay. All right. So I'm going to start, we'll go higher or lower. Okay. See how I do this. Okay. 50%. What do you think of that's higher or lower than that? It's lower. Okay. All right. So let's go to 20%. Do you think it's higher or lower than that? It's lower. All right. 10%. Let's go higher or lower than that. It's lower. Okay. 5%. It's higher or lower than that. It's lower. Okay. 3%. Higher or lower than that. It's lower. It's 2%. 2% of all reported frauds were captured by the external auditor. We are useless. Wow. All right. So knowing that actually it makes sense if you think about it. We're external auditors. We come in for a very short window of time. We assess the financial statements and then we leave. We are not there during the more normal daily activities. And especially if the client knows when the auditor is going to be there, they can disguise the fraud because clients are really smart, especially those executives. They're very sneaky and wily. Okay. So what would be the best approach as an auditor if you're concerned about fraud? And the answer is talk to the people who know about where the fraud may occur. This is where we're going to inquire of management, the audit committee, and others. Okay. This is where we're going to talk to management about their knowledge of fraud within the entity. Now, if the management's the one committing fraud, certainly that's problematic. But for the most part, we're going to assume that management's going to share their notions. Also, people within the entity who are not management, if they can actually share their observations, that's something we should take in consideration as well. So also want to talk to the audit committee and make sure that they assume an active role in oversight in the assessment of risk of fraud and consider inquiries from others within the entity and third parties, vendors, customers, and regulators. This is one of those rare times that we talk about inquiries to people outside of the organization, especially if there are problems that have repeatedly occurred. Might actually be some speculation on why there might be issues. So vendors might tell you, this is very, very weird. My prices have been going up, but another vendor I know has had a pretty consistent prices over time. I don't understand why my price is going up. We might say, oh, there may be a related party interest there that exists that we have to investigate further. Some possibilities there, but we want to get as much information as possible if we're the auditors. Because who's going to know more about fraud within the entity? The auditors or the people who are actually doing the day-to-day business of the entity? Make sure the people within the day-to-day business. All right, so an interesting question. Okay, interesting question. Over the past 25 years, what percentage of frauds do you think were discovered by tips from internal and external sources within the entity? We'll start at 50% again. Do you think it's higher or lower? Higher. It's actually right at 50%, so it was kind of a trick question. Yeah. So it's right at 50%. About half of them are recorded by external tips that are internal and external tips. Okay. So technically you're correct because it depends on what area. Sometimes it can be higher, sometimes it can be lower. So everybody get themselves a pat on the back, being right about that one. You were all wrong about the auditors, okay? But no, that was not a fair question. That was a misleading one. All right. So that kind of leads us to what it is that we need to do to assess fraud risk factors. Now, fraud risk factors have something in a root that we've talked about back in AIS before. Does everybody remember Cressy's hypothesis back from AIS? So Dr. Donald Cressy, he wrote the following. He said, trusted persons have become trust violators where they conceive of themselves having a problem which is non-shareable, or where this problem can be resolved by the violation of position of financial trust, and are able to apply their own conduct and situation verbalizations which enable them to adjust their conception of themselves as trusted persons. All right, with their conception of themselves as users of the entrusted funds or property. Now, there's a reason I underline that because I like to break that down into a little bit more specific details. So something that you should be familiar with, I think we talked about this back in AIS, but I want to make sure that they're clear. Does everybody remember the fire triangle or ever heard of the fire triangle? Did you ever watch like Saturday morning cartoons? Do they even have Saturday morning cartoons anymore? I heard that they were getting rid of those, and I was just kind of mad because I spent all my Saturdays eating sugary cereal and watching cartoons, and that was the life right there. It explains a lot about me too. But they had Smokey the Bear on Saturday morning cartoons. Okay, has anybody heard of Smokey the Bear? So only you can prevent forest fires. But Smokey was saying, beware of the fire triangle. Okay, for a fire to occur, there has to be oxygen, heat, and fuel. All three conditions have to be present. And generally speaking, you want to be very, very careful about the heat because you can't eliminate oxygen. We live on a planet that is sustained by oxygen, at least we are. Can't really eliminate fuel, especially if you're in the middle of the forest. There's a lot of sources of fuel. So you got to make sure you eliminate that heat, which is relevant, by the way. That seems like I'm not talking about auditing anymore. I'm talking about fires, but I do want to talk about this elimination concept, okay? Eliminating one thing is the one thing we can control. Well, let's apply that to Cressy's hypothesis, okay? Cressy says, having a financial problem which is non-shareable, there is an incentive or pressure to do something wrong. This problem can be secretly resolved by the position of, or by violation of position of financial trust. There is an opportunity to do something wrong. And then finally, they can apply their situation or to the conduct of their situation. Verbalizations enable to adjust them conceptions of themselves as a trusted person. I shouldn't have read that whole thing out. This is called attitude or rationalization. So if oxygen, heat, and fuel were the fire triangle, this is going to be called the fraud triangle, okay? And the fraud triangle basically says there's three components: an incentive or pressure, an opportunity, or rationalization or attitude, all right? The fraud triangle right there. Three conditions that have to exist in order for fraud to occur. So we as auditors are going to be very concerned about trying to identify situations in which pressures may exist, opportunities may exist, and there can possible rationalization. So say, for example, we deal with management who've got very aggressive sales goals in order to achieve their bonuses. Are we going to want to be aware of that as auditors when we're considering the possibility of fraud within the organization? Yes. What if historically management has been very, very quick to book misstatements that we're aware of? I say they can very easily rationalize their actions. What if they've got very poor controls in the organization? They do not have good controls, and so it's possible that more fraud can occur. That would be a good opportunity. Now, the thing to note about the fraud triangle is that we as auditors want to be aware of all three of these factors, all three of these fraud risk factors. They are all important and they're all signals that fraud may be present within the organization. That being said, which one do we have the most control over? I would say almost exclusive control over as auditors. Remember, we talked about the fire triangle and so you can't eliminate oxygen, you can't eliminate heat, or can't eliminate fuel, but you can eliminate heat. In this one, we can probably control one of these more than we can control the other two. Which one would that be? Opportunity, yes. We can look at the client and we can say controls are bad, you got to fix these controls, because if these controls are not present, then fraud is going to take place. We need to be very much aware of that. All right. So that leads us to the final steps, some things that we need to know with respect to misstatements. First of all, the auditor's response to the results of risk assessment. So this is just general about risk assessment as a whole. If we look at risks and we say that the risks are different than what we expected, we want to make sure that we assign more experienced or specialized personnel, particularly in areas that may require more expertise about a particular account or area of accounting or a particular scenario. We also might want to consider whether any of these chosen policies or procedures are indicative of fraud. So if fraud is likely to occur in a particular scenario, we may want to take that into account when we're designing our procedures, how we're going to perform the audit. Again, remember, we as auditors have a responsibility to detect fraud that has a direct and material effect on the financial statements. One thing that we're going to talk about, we're going to allude to this a few times within the course, is may want to incorporate unpredictability in the selection and nature and extent of timing of audit procedures. So remember earlier I said that management is really, really smart. And if they know when the audit's going to take place, when the testing is going to take place, then they can obscure it by making sure that they act in a different way and do different things during that period of time. If you know management, or you suspect management is trying to disguise a fraud, what would you do? You'd basically do things that are unanticipated. You'd perform testing at unannounced times. All right. Let's assume that I want everybody in this classroom to know audit 100%. I want you to have 100% knowledge 100% of the time. Instead of right around the exam period when you're all going to naturally just cram all that material, you're going to get that study guide out and said, I'm going to spend the next 5 hours memorizing this thing from front to back, okay? What if I said, I want you to know it all throughout the semester? And I could say, I could give you pop tests, all right? Be terrible from a morale perspective. Everybody would be just miserable, but it'd be great from an audit perspective. All right, that would be an example of incorporating unpredictability. Fortunately, I don't consider you all big fraud risks, so I'm not going to worry about, I'm not going to do pop tests. I can only imagine, maybe last year teaching this course, I said, you know what, I really want to see if there's a delta here. I'm going to do some pop tests on you all and then see how the students react to that. And then you guys can commiserate with those students and say, I remember Dr. Barnes talking about that. I didn't think he'd actually ever go through with it. Yeah. All right. Evaluation audit test result. Has a material misstatement occurred? If the answer is yes, then we talked about this already. Management will have to make an adjustment to the financial statements in order to avoid the material misstatement. If management refuses to make an adjustment for material misstatement, what are the auditor's options? Generally speaking, we have to issue something other than a clean opinion. So unqualified or unmodified, remember those are our clean opinion types. If we do have a material misstatement, we either have to issue a qualified opinion if we believe it's material, or an adverse opinion if we believe it's pervasive. Now, remember, we talk about a material misstatement. This is implying that there is a departure from generally accepted accounting principles. The financial statements are misstated in such a way that the client has departed from in a material way from generally accepted accounting principles. That is also usually predicated on the size of the misstatement. If it's big, but not gigantic, remember we said material, but not pervasive, that's where we say a qualified opinion. And if we said that if we think that it's pervasive, that's where it's an adverse opinion. By the way, we did allude to this back in chapter 1, but just as a refresher, if I'm going to issue a qualified opinion, what 2 words are going to be in my audit report? Does anybody remember those 2 words? It's except for. Financial statements are free from misstatement except for this particular issue. If I'm going to issue an adverse opinion, that's where there's a pervasive material misstatement, a pervasive misstatement. That's where I'm going to say the financial statements are not free from material misstatements. They are materially misstated. What if fraud has occurred? We want to gather evidence of fraud. We want to consider implications of the audit, and we want to talk with the matter to the appropriate level of management or the audit committee. Okay. Now, there may be some caveats to that. You may be saying, what if management's committing the fraud? What if they're pulling another Enron on us, Dr. Barnes? What if they're pulling another Lehman Brothers? And I say, well, good memory, good examples, okay? But what if they are? We'll talk about that here in just a second. So we want to document the audit test results. We're going to talk about documentation methods here shortly. One of the things we're going to find is that whenever we do anything in audit, it has to be documented. We have to document our processes, have to document our responses. Auditors should document the risk of material misstatement for all material accounts and disclosures in terms of the related assertions. We're going to look a little bit more in depth in that over the course of the semester, but specifically, we're going to look into a little bit more depth in next chapter. Chapter 5 is our documentation chapter. We also want to communicate fraud. Whenever the auditor has found evidence that a fraud may exist, the matter should be brought to the attention of an appropriate level of management. So generally speaking, when we talk about appropriate level of management, it's going to be the next highest level of management above where the fraud occurs. So say that you're doing an audit and you're in the warehouse and you're looking at the assembly line and somebody in the assembly line is pocketing parts and putting them in their pocket. I guess that would be the only way you could pocket parts is to put them in your pocket. Okay. Yeah, I just redundancy for the sake of redundancy. Yeah. So who would you talk to? Probably go to the line manager and say, yeah, one of your employees is stealing from you. What about if it's somebody who is filching inventory, but it's a higher level, somebody like at the regional manager level? You may want to report to the executives, to the upper executives in management. Now the question comes up, what if it's Enron? What if it's the CFO, the CEO, the controller, the highest level of executives in the highest level of management in the organization? What if they're ones committing the fraud? Seems like reporting that to management would be pointless. Hey, we found that you're committing fraud. Can we get on in on it? Yeah, that's the Anderson approach. That's not the approach that you should take. If fraud involves senior management and fraud that causes a material misstatement of financial statements, those should both be reported directly to the audit committee. So if you get to the highest level, now you notice there's a delineation there. If it's fraud involving management, or it's fraud that causes a material misstatement, it's fraud that causes a material misstatement. So anything that causes a material misstatement, we report to the audit committee. Any fraud involving senior management, regardless of whether it's material, that's also going to be reported to the audit committee. Fraud does not have a materiality threshold for all intents and purposes. If you identify fraud, you as auditor don't go to say, well, that's not material, so I'm not going to worry about it. If you identify fraud, you do need to report it. Now, you have to use some common sense with that. Like if you go down to the commissary of the organization, like they say they got a gift store in front of their place, and you see one of the employees filch a pack of gum, you probably don't need to report that to senior management, okay? But if you do note their management's committing fraud, and even if it's not a material amount, you do have a responsibility to report that to the audit committee if it's senior management. So we're talking about the senior executives in the organization. All right, that does it. So yeah, we're done with chapter 4, but now we've got a little bit of an activity here. All right, so I'm going to change this activity up. So it used to be I have 3 volunteers for this activity. The problem is that that was back when I taught like 40 students at a time, and this is a fewer. If I don't have enough students, then this won't work. So here's what I'm going to do. I'm going to punish Kate. I'm sorry, Kate, it's nothing personal against you. You're just the one observer. You're not in the middle of the room. So Kate is my observer. And let's see. Here's what I'm going to do. So awkward. All right. Kate, can you see the class?
Yeah, most of them.
Okay, well, that'll be sufficient. That'll be sufficient. All right. All right. Here's what we're going to do. I'm going to go ahead and move this on. We're going to think critically with the wave. Now, again, like I said, this normally takes three people. I'm going to chop and remove the two observers, but Kate is going to be our third observer because Kate is unfortunately at home right now and ill, and so makes perfect role for observer for everybody else in there. All right. So basically, what happens is I've got an external participant, a volunteer. Okay, so that's Kate, and the rest of the class is going to be the wave. Now, has anybody ever done the wave like in the crowd at a sporting event? Okay, so basically that's all we're going to do the wave. Okay, what does this have to do with audit? Well, it actually has a lot of relevance to the audit, but I mostly just want to get everybody up and active. Just no. All right, so here's what we're going to do. So we're going to start. And by the way, I'm at the front of the classroom right here. Okay, I'm at the front of the classroom. The start is going to take place in the back of the classroom. I say we're going to start with Alex. Okay, and it's going to go in a snake. All right, so over here, then over here, over here, and in with Ethan right here. Okay. All right. So let's just go ahead and try this. You don't have to stand up, by the way. You just do the wave from your seat. I'm not that cruel. Okay. All right. So here we go. Start. It was good. It was good. It's like you've done this before. All right. Yeah. Okay. All right. Kate, what was your impression of that, Kate? Pretty good?
Yeah, it was great.
It was great. All right. Yeah. Enthusiasm at the top levels right there. All right. So here we go. I'm gonna do more than one this time. All right. We're gonna see how we do on this one. So when I point at you, Alex, so start the wave. Anytime I point. Ready? Go. Okay, that was pretty good. I think we started three and we finished three, so that's pretty good. All right. So I think we're ready to kick it up a notch. What do you guys think? All right. So this time I'm gonna have two waves, and one starts with Alex on this hand, and the other one starts with Colin on this hand. Okay. So if I have on this hand, it's gonna go here. It's gonna go in this way and finish with Anna. All right. So let's go ahead and do one example wave just like that. All right. All right, pretty good. Okay, so I think we are ready to have this happen. Okay, so we're gonna have interspersing waves. So again, I point here, it starts over here. When I point here, it starts over here. All right, and everybody's got to keep track. Everybody ready? Here we go. Oh, oh. Well, see, I started 5 waves and I think only like 2 finished. All right, this is really important, guys. Okay, I need you guys to buckle down and take this seriously. We're gonna try this again. All right, we're gonna try this again. All right. Do we need to do more practice? Okay. We got like 15 minutes. We can do practice on this. Okay. All right. Don't let our observer down. Okay. Or don't let our observer down. Here we go. That was better, but you still missed a few. Still missed a few. All right. All right. This is the last time. This is 5 times. Okay. So this is an in-class assignment. This is for credit. Okay. If you guys don't complete this one, I'm not giving any credit out. All right. So here we go. You guys have failed me for the last time. Yeah, that was that. Yeah, that was I should have expected more. Yeah, yes. All right. Hold on. So let's go ahead and talk about this. This did not work out. This did not work out. Now, what are some ways that we could have improved the process to reduce failure in the exercise? Be linear. So instead of doing a snake pattern, like just like everybody did the wave at once, yeah, be a very short wave, but yeah, it's possible. Any other ones? A little bit more connected, yeah, yeah, there's some segregation going on, there's separation going on, yeah, so what else?
Only come from one side.
Only come from one side. Was it challenging working from the back to the front? Could I have started with the front and maybe gone to the back instead? That'd have been a lot more visible for everybody. I have a feeling like Dorian and Andrew, I was sitting up here. That was kind of a challenge. So yeah, so the back. Maybe if I insist on starting from the back, like do some auditory cues, like when Colin's about to change the wave over, he basically says now, or same thing for Alex on there. Okay, so possibilities there. So everybody agree that this was unnecessarily complicated? All right. Time to talk to our observer. All right, Kate. All right. You got to observe firsthand what's going on in this wave exercise. So here's what I need from you. All right. The observed failure in this exercise is a function of its components, in this case, students of the class. Okay. So the reason this whole thing broke down is because somebody in the class broke it down. All right. Somebody in this class broke the wave down. And I'm interested in finding out who. We need to address the causes of failure. So here's your first option. I need you to identify 3 students that you believe is most responsible for the failures in the wave. These students will receive no credit. By the way, today's class activity is worth 5 points. Kate picks you out. Then you don't receive any points. It's 0 out of 5. It's like, that's not a material amount. It's the principle. Okay. It's the principle. Okay. I guess I did say that you have to complete all in-class activities to be opt out of the final exam. So if she calls you out, then she's forcing you to take the final exam. Ooh, all right, so there's that. Okay, there's another option if you're a little bit afraid and worried about reprisal from your fellow classmates. I'm thinking of a number 1, 2, or 3. If you guess it correctly, everyone gets full credits for today's exercise. If not, everyone in the class will lose 2 points for today's exercise. All right, so this is up to you. Putting you in the role of observer, Kate. You got sick, and then I'm making you suffer as a result of it. It's just I'm not that kind. I'm not a good person. What do you think, Kate? Which option do you want?
I think I want to do option 2.
All right, what's the number?
1.
You guessed correctly. It was option. It was correct. Yeah. So well done. All right. She didn't want to out 3 students, but she guessed the number correctly, so it all worked out for the. Oh, I wasn't going to penalize you all anyway. Okay. Regardless of what happened, everyone's going to get full credit for today's in-class exercise, but you do have to answer some questions for me. Okay. So you guys think you answer the questions for me? All right. This exercise was extremely complex and susceptible to consistent failures. Can we agree to that statement? Okay. So I didn't fail, Dr. Barnes. It was somebody else. Yeah. All right. From an audit perspective, what does the wave exercise represent? Yes, but more specifically, something we've talked about. You're correct. You are correct. But how do we characterize that from an audit perspective? So when you go into business, you're susceptible to certain challenges just by immediately going into business. Okay. What did I say that was called? We talked about this last Friday. Inherent risk. Very good. Inherent risk. There's a massive inherent risk associated with me doing the exercise in this current form. All right. If I say we're going to do alternating snake wave, everybody's like, gosh, this is going to fail. All right. And it is. It was designed to fail, by the way. It was designed to fail, but that's really not the point. All right. That's really not the point. It's susceptible to extreme complexity or to consistent failures and extremely complex. Those are the risks associated with the activity in its current iteration. All right. So does everybody understand how this applies to that concept of inherent risk that we've already talked about? All right, let's think a little bit more about it. So we actually had a poll where I said, hey, how do we fix this problem? How do we fix this problem? From an audit perspective, what do these improvements represent? Controls, they are controls, okay? We identified the risks that are present and we said, here's where the problem's breaking down, Dr. Barnes. You're doing a snake when we should all be going in one direction, or we should be starting from the front, or we should be doing something else, something to fix the problem. When you fix a risk, when you address a risk, that is a control. So this is kind of the alignment of that idea, the alignment of the idea. We know that there's going to be risk present. We have to have solutions for those risks. So that's basically the case. Now, Those are very, very specific to this particular context in the chapter. Again, we do know that these are outside of our control. As an auditor, we do know that we can't fix inherent risk. Inherent risk is just naturally going to be present in every scenario that we deal with. Control risks are also outside of our control. That's something the client does. But we do need to be aware of those as the auditor and be able to address those. Now, something we do have some control over, but we don't necessarily want to address it is going to be that last question. This is the challenging one. And this is unfortunately, I leave the class on a low note on this one. And hopefully everybody's not going to drag this with them. But, you know, Kate was our auditor. Okay. I don't know if anybody figured that out, but I made her an auditor. All right. And so I put her in the uncomfortable position having to impose a penalty on people in the class. Does everybody remember that? Said, yeah, pick three people out. Pick three people out. How does this relate to an auditor's responsibility in the real world? In the real world, are you going to be given a second option saying, guess what number I'm thinking of? No. There's not that fluctuate. And the reason why is it always happens every single semester is that I have give the option. I've been doing this exercise since I've been teaching audit, which now we're going on 10 years to be teaching this class. Twice have I had people who have said, I'm going to identify the people who are with the breakdown. One of these students actually called me out and says, yeah, you're not going to penalize the students, Dr. Byron. She called me out like that, says, yeah, I knew it wasn't going to happen. Another one actually said, I'm going to pick my friends, they'll forgive me. All right. In the real world, you don't have those friendships. It would be nice to say that's the case. Now, here's kind of it's a fictitious example, but it actually relates to something I dealt with. I actually did an audit where I was working. I guess I can turn this off. I'm back. And so, yeah, I was doing an audit in the middle of Western Texas, a little area in Odessa, Midland. Has anybody ever been in that area of Texas? Yeah, there's nothing out there but oil. Okay, there are actually a couple of good restaurants, but I was doing a audit for a company in that area, and this is a little bit fudge, but it's not too far from truth. It was basically a rural audit because the people who worked out there were people who were fairly blue collar and they didn't have a lot of corporate knowledge and experience. So the people who were kind of the administrative assistants, they didn't have college backgrounds. They had high school educations, and they were very, very friendly and very, very easy to get along with. But they made a lot of mistakes in their job, and we were out there auditing, trying because this company had just grown massively in over a short period of time. And so they were implementing a lot of new processes, a lot of new protocols. They were implementing a completely new technology system. And one of the ladies up front who I called on many times to help me out, she was very, very nice. She was probably in her mid 50s or so, which at the time seemed old. Now, doesn't seem that old to me anymore. But yeah, she would help me out and be friendly. She even gave me candy sometimes. It was kind of cool because I was out there all by myself and just doing this audit. And I had to come to the conclusion that she was one of the ones responsible for the control failure. She was not updating she was not doing the processes in the system that she needed to do. She was responsible for basically some checks and making sure that those were approved in the system. She didn't like the system. She liked her manual process that she did before. So she was one of the impediments there. Now I had to grudgingly, and again, this is dramatized. It was not nearly as bad as I'm making out, but I do want to make it clear. I had to point her out and saying, this is one of the control failures. And I don't know what happened. It's entirely possible they said we're gonna have somebody else in here because you can't do the job that we're asking you to do. That seems pretty harsh, doesn't it? Would you want to be put in that position as an auditor? That really sucks. But what are the consequences if I don't make that choice? If I don't make that identification, if I don't say, yeah, she's wonderful, she's a great human being, but she's woefully unqualified for this position. She does not understand the computer infrastructure. She doesn't understand the things that need to be done. There's massive control failures that are going on in this department right here. So she loses her job, and I'm going to feel terrible about it. But I ultimately knew it was the right decision. What did I avoid by making that decision? I avoided the possibility of the entire company going bankrupt because of a massive control failure or a fraud that occurred because of the failure. And then not only her, but everybody in that area, that vicinity, loses their job. It sucks to have to make that decision and appoint somebody out, especially somebody who's really, really nice, but that's your responsibility because there are larger consequences on the horizon. You have to be cognizant of those. So keep in mind that just because it's a difficult choice to make does not mean that's the wrong choice to make. And with that terrible, terrible thing to tell you guys, I'm going to call it good class. We have homework on Friday as well as ID assignments, so I'll see you all then.